Which are the most preferred investments of US citizens and how will each one perform in the following years to come, according to history and according to the greatest investors in the world? These are the crucial questions I'll answer in this video, and as always said with educational purposes and is not meant as financial advice. I want to start with the least preferred investments, going to the most preferred, and I will analyze each one and its potentials and risks. The data is from the end of July of 2022 and it comes from a survey done by Bankrate. Only 3% of Americans do not have any investment preferences and practically do not invest in anything. Although this is not correct, as we are always invested in something. If not in assets, then we are 100% invested in cash, which is not ideal as this does not offer us any diversification protection and we are constantly exposed to the eroding forces stemming from inflation. To calculate how fast inflation erodes our purchasing power, we can use the rule of 72. If we divide 72 by the rate of inflation, the number we get are the years in which our purchasing power will be cut in half. For example, the current rate of the US inflation is about 8%. If we divide 72 by 8, we get 9. So if inflation stays the course at around 8%, then in 9 years we will buy 50% less stuff with the same amount of cash. Just a quick side note, we can use the rule of 72 also to quickly calculate how fast our money will double if we had a certain annual rate of return. For example, if we had a 15% return per year, which is an outstanding figure, we divide 72 by 15 and we get 4.8. So in less than 5 years, our investment sum will double up. Down the line, the next most preferred asset class is the cryptocurrency asset class, with the exact specification being left out of the survey, which asks people if they invest in Bitcoin or other cryptocurrencies. Here the data could be a bit vague and misleading. Bitcoin is the so-called king of this space and has absolutely nothing in common with most other crypto projects. This is due to its level of adoption. The smart money is mostly invested there as well as in Ethereum, which is the other main cryptocurrency. All others exemplify very high risk and uncertainty, as do both Bitcoin and Ethereum, but the differences are quite vast. I personally would not put all my money in this space as it has only a 13-year history and now it is the first time when the sector is experiencing times of quantitative tightening, meaning higher interest rates and lack of money printing from the Fed and all other major central banks. Usually in these times, assets that do not produce cash flows are considered more speculative assets, and the only way I could profit from them is to sell them to someone else at a higher price. When the system is tightening, capital is less available and much less people tend to speculate. It would be very interesting in the coming years to see how this asset class will evolve, and I certainly am not against it. I have been invested in it for more than half a decade, but I treat it with caution. The survey shows that younger people are much more akin to investing in the space, as 34% of Gen Z investors they feel comfortable investing in the space, and only 11% of baby boomers say they were confident. The space will truly blossom when the baby boomers and Gen X start to feel more comfortable, as most of the capital is in their hands, as they were much longer on this planet to accumulate wealth. About 9% of Americans prefer bonds as their top investment choice. Last year, during 2021, Bankrate made the same study, and then only 4% of the people polled said bonds were their actual cup of tea. Since then, a lot of assets have been crushed, like stocks and crypto, but bonds have not been left out. As New York Times states in their recent article, bonds may be having their worst year yet. Bonds are witnessing their worst performance since at least 1926. This is almost 100 years ago. This is because bonds tend to perform very badly in times of high inflation, and their value erodes just like cash. A bond is a promise that a corporation or government will pay you a fixed yearly percentage of return, and at the end of the maturity of the bond, they will pay you back your cash principal. The current yield of the most bought US bonds, the 10-year Treasury, is about 4.5%. At the same time, inflation is sitting at 8.5%, which means that the actual real return from the bond is minus 4%. At the same time, the principal becomes less and less valuable as it is a promise for cash to be paid out, and inflation erodes the purchasing power of our cash reserves. I personally will not be buying bonds anytime soon. I will wait to buy bonds when the yields become closer or higher than the inflation rate, which will indicate that soon the inflation will start to go down, and the bond then will make a very high return for the course of the next 10 to 30 years, depending on what kind of government duration bond I am buying at the moment. Even the great Warren Buffett admits he made a mistake in the early 80s for not buying much heavily bonds, as their yields were 15 to 20% back then, and he could have fixed these returns for a very long time, crushing most other investments. In the investing world, all asset classes have their rising moments and downfall moments, and everything is cyclical. This is why you should subscribe to the channel now, as I cover all asset classes here, and my mission is to help you become a more well-versed investor. Again, at 9% are gold and silver investments. I have extensive analysis and separate videos on both of these assets, so make sure you watch them here on the channel. In general, they offer a historically proven crisis and inflation protection hedges, but I always tend to want to buy physical coins and bars, as the premiums in comparison to spot ETF gold and silver purchases are much higher when prices tend to go up. Over the last 15 severe stock market crashes, only once gold underperformed stocks, and this was in 1980, when gold was at the peak of its bull market cycle, going from $35 in 1971, when Nixon removed the gold standard, to $850 in 1980. As Ray Dalio says, those who do not own gold do not know history, nor they understand economics. Around 17% of people prefer having their investments in saving accounts or CDs, which stand for Certificate of Deposit Accounts. This is a bit better than cash, but still quite the same. I've found a list from Bankrate which shows the current annual percentage yields of all top banks. The lowest APYs are starting from 1/100%, while on the high side other banks offer up to 3.6% APYs. The bigger banks like Bank of America, Wells Fargo, US Bank, Chase, and others all offer very low yields, while lesser-known banks offer higher yields. But of course, there is risks in consideration to always have a higher APY. In general, having your investments in savings accounts, just like bonds and cash, is setting you up for currently a 100% loss of purchasing power, as the inflation rate is higher than the yields. The stock market is the second most preferred place Americans like to put capital, with 26% of people surveyed feeling most comfortable there. Over the past 10 years, only in 2018 and 2020, the percentage of people was higher, with 32 and 28% respectively. In the coming years, not all stocks are going to perform well. Each time when we exhibit high inflation and monetary tightening, stocks fall quite a lot. Now it is more important than ever to be well educated and know the difference between bad and good stock fundamentals. I personally recommend you to watch my individual analysis here on the channel, as they offer incredible, easy insights into the world of proper stock investing. And they offer the teachings that are coming straight from people like Peter Lynch, Carol Icahn, Warren Buffett, Charlie Munger, Seth Klarman, Ray Dalio, and many other greats. The most preferred investment class in 2022 is real estate, with 29% of people feeling most comfortable there. But the real estate game is changing quite fast. The following chart is by far the most important thing to watch out for, and it is the 30-year fixed mortgage rate chart. Today, we're sitting at a 20+ year high on the 30-year mortgage. These levels cannot be maintained with the same level of home prices, and the slowdown in the US housing market is evident, as the data derived from Charlie Bilello is showing us. Home prices are still going up, yes, but they're past their peaks of home value rises. Both prices and rents are going down, and sooner or later, these percentages will turn negative. As I said earlier, all asset classes are cyclical, and the cyclicality is a major force behind the investing world, which just cannot be controlled nor destroyed. I have several videos about the US housing market on the channel, where I cover in greater detail the ins and outs of the current situation. Also, I have analysis regarding some specific US cities like Las Vegas and others soon to come. Subscribe and comment down below what future videos you want me to cover here next on the channel. In general, the current economic times are very uncertain, and very rarely in history we have had high inflation and monetary tightening events. This is why diversification is more important than ever, and one must gather knowledge constantly in order to evolve and outperform the general market. With this, I end the video. Comment, like, and share, and I'll see you in the next one.